Today's topic will be handling the risk management and money management. Risk management and money management. There are two different things. So risk management has to do okay, let me start this way. Managing your risks, it's during the process of planning to trade and the actual trade in itself. So before you take any trade, you already have a plan. Before you take a trade, you already have a plan of what your risks should be. So you plan first before taking an action. If you enter in on a trade and then begin to make plans on your risk management, you're going to make such decisions based on emotions. So you don't enter in on a trade and then begin to think about, okay, where should I set my stop loss? No, it's wrong. So you sit down, make a plan before you start trading. That is why we'll oftentimes say or encourage that Forex should be taken as a business. Because for any business transaction you want to make, you will count the costs of everything. So let's say you want to sell eggs. You need to sit down, okay, how much do I have, right? How much do I have? How much do I have? Then how many crates of egg can I buy with the amount I have, right? Then how much do I want to sell? Maybe you're buying 10 crates. How much do I want to sell a crate, right? What should be my profit in selling one crate of egg? Then finally is the risks, which many people do not include. What if one crate of egg breaks as they are transporting it down to my house or wherever? Or what if, as I'm handling it, 10 eggs break? How do I now sell to still make profit? This is business, basic business, right? So you need to bring also that idea into the Forex space. So risk management is very critical. Most times Mr. Destiny will say, he doesn't just want to point out the sweet things in Forex and leave out the things that many people do not focus on. Now, what makes you a good trader? First, your strategy. I know people talk about strategy a lot, but sincerely, your strategy is more like 10% of your profitability, or what will make you profitable, 10%. The strategy is not the holy grail of you becoming a successful trader. Yes, good strategy, having an edge in the market, it's excellent. But your strategy is more like 10%. Your risk management, right? Your risk management is 40%. Now, it varies, depends on which trader is teaching you this. Your psychology. Don't worry, when we start teaching trading psychology, you know how important it is. Your psychology is 50%. Trading psychology has to do with how you manage your losses. It has to do with fear of missing out. It has to do with greed. It has to do with chasing markets, revenge trading. All has to do with psychology. And this is the area where many traders find it difficult to make adjustments. Now, I often say, okay, maybe I've taught Rosimi on this. I often say that you can learn the skill of trading in 3 months. You can literally learn everything. But the act of you becoming a trader is different. You know, trading will teach you, or trading relates to spirituality in many areas. It's just like you having knowledge of the word, but for you to now put that word to practice, that's where the key is, like the difficulty is. So many believers know many things, but to translate what they know into results is where the problem is. And it has to do with the mind, and that's the psychology. So, for example, you know that you should use 10%, sorry, you know that you should use 10 pips SL, right? You know that. And you know that if you don't use 10 pips SL, your account will blow, right? But this person knows this, but why is he not practicing it? Yet he will still enter in on a trade where the pips to the last point of high or low is even higher, and maybe it's 20. Now, when the trade takes this person out, the person begins to now wonder, why in the first place did I even take this trade? That's where psychology comes in. Psychology also covers what happens when you, in a week, you keep losing. You have a losing streak. Monday you failed. Tuesday you took a loss. Wednesday you took a loss. Thursday you took a loss. Friday you took a loss. What will you do? It has to do with psychology. Because sometimes you are doing well with managing your risks. Your strategy is okay. But at that point in time, given the market situation, your strategy is not just working out, right? So what would you do? It has to do with psychology. So psychology is another topic, and is one of the key parts. Most professional traders, they pay heavily psychologists. Yes, the ones I know, they pay heavily for psychologists to train them, to train them. Abel, you're on the bed taking Forex class. If I catch you. So let's talk about risk management. So this is the first risk management. So is any actions you will take before and during your trade? Before your trade and during your trade. Before your trade and during your trade. That's what risk management covers. But money management covers after you have made your profit. What should you do after you've made your profit? What should you do? Because many traders don't know that after they have made money, your psychology can still haunt you and you go back to ground zero. Yes. So there is a way to manage money after you've made money from the Forex market, and we'll be teaching that. So I just want to clear the fact that these two are different. Risk management is what you do before and during your trade, but money management is what you do after you have made the money from the Forex market. Okay, so let's go. Let me copy this and we can discourse about risk management. Okay, let me stop sharing this guy. Okay, so this is what we've got. So first of all, why is risk management important? So let's discuss risk management first. We'll talk about money management later. That's advanced class action. Okay, so why is risk management important? Does anybody have an idea? Why do you think risk management is important? Why is risk management important? Yes, Abel.
For me, I would say to know how to like position yourself in the aspect of maybe trying to buy, like positioning for your move, so you don't. Yes. Let me stop there.
Position for your okay. Let me start by saying what is risk? What is risk? Before we know why it's important in Forex, what is risk? Because every business, there is no business that has no risks. Every business has a risk involved in it. So if someone is not given to risks or does not like risks, that person cannot be a business person. And most importantly, that person cannot even be a trader. So that person cannot be a trader because trading also involves risks. So first of all, what is risks and why is it important for you to learn risk management in Forex trading? So what is risks? What is risks? And nobody know what be risks. So nobody has taken risks here before. Oh God. Okay. So risks is simply any situation that might expose you to danger. In this term now, in Forex now, is losses. Any situation of the market that might play out and eventually lead to a loss, right? It's as simple as that. So that's what risks is. That's what risks is. It's as simple as that. So it is important in Forex trading because why? It is possible for you to lose your money. And that is it's still as simple as that. You can lose your money, and the amount of money you can lose is okay. Mr. Destiny, you're raising your hand.
Oh, um, sorry, just to add to it, yeah. Risk is like possibility of something bad or something that is not favorable happening to you when it comes to business or finances or the market. It's not like possibility of you just losing your money, even sometimes when you are not at loss. When I mean when you are not at like financial loss, but the market is playing with your emotions, that's also considered risk in trading and all that. So I just wanted to put that out there. It's just possibility of something not going your way. That's risk in general when it comes to trading.
Okay, thank you. I hope we're following the class, right? Uncertainty. Mr. Abel, uncertainty. Mhm. Yes, Mr. Destiny.
Oh, I think I just finished what I wanted to say. Then I mute myself back. You can
Oh,
continue.
okay. Okay, okay. All right. So it is important for you to learn risk management in the Forex market because there are many situations that can expose you to either danger, harm, and losses. So, well, like the other day, hmm, the truth is, don't joke with Forex, the Forex market. It can really affect your psychology and in turn your behavior. You can literally just lose your temperament because of a loss or probably a plan you already made on a trade and it didn't just go well. So it is important that you learn this so you can avoid such situations. And of course, well, like I said, we're going to still talk about um, trading psychology and all of that. So risk management is very, very important and critical. You can see somebody just come in with um, even 5,000, 10,000, any amount of money, and you can lose it in a minute, 2 minutes, 3 minutes, sometimes even split of seconds. So it is important you learn risk management. Now, one beautiful thing about Forex trading is that your risks can be effectively managed in the sense that you can actually determine how much you want to lose. Yes, you can determine how much you want to lose in the Forex market, right? You can determine it. There is no other business, really. There is no other business that has a defined loss or risk. If you are doing real estate, you can't define it that, okay, bad as a bad, I'll just lose $50,000. No, it's not defined. Like the example of the business of selling eggs. You can't tell, okay, this month is only one crate of egg that will break. No, you don't know the amount, it's uncertain. But in the Forex space, you can actually determine that, okay, this particular today now, this is the amount I want to lose. but it's also boils down to the discipline of that trader. So in Forex, you can say, okay, today I wake up now. I feel excited. I want to just, I have $10 to dash the market or to make profit from it. And you can keep to this amount strictly if you understand risk management. It doesn't have to be above this, but it can still be below this anyways. But you can determine the risks per trade, per day, depends on your plan and your strategy. So don't have that fear that, okay, well, it has to do with discipline, like I said, but many people just believe that Forex is too risky. You don't know how you will lose money. This might happen, that might happen. Well, it just happens to traders who really have not mastered discipline and their psychology. But just bear this in mind, based on the system around Forex, you can determine your risks. Now, in Forex, it is better to define your risks by percentage. And there is a reason why it's important to define your risks by percentages. So for example, let's say you have a $500 account, right? You have a $500 account. Now, this is why I love prop firms, right? Prop firms, they just the system teaches you how to calculate risks, how to maintain discipline. Like prop firms will really teach you that. Calculating of risks, I didn't used to see it as something that is important that much until I started, because then I would just put money in life account and just throw it to the market, because I felt that, oh, this money is just small. There's no need calculating. No, it's bad. Even if it's $10 you are funding your account with, you should also learn risk management, right? So you have a $500 account. On a daily basis, you can determine by percentage how much you want to lose from this money. So let's say, given this amount now, you want to lose 10% of your trading capital, 10%, which will make it $50, right? $50. So let's say you plan to enter in on maybe 2 trades per day for a day. You saw a good setup on GBP USD and you want to enter in on a good trade. And you want to make at least 2 trades for a day. So this your daily loss now. No, not daily loss. This daily percentage of drawdown you are willing to take, you're going to split it amidst the 2 trades that you now. This thing I'm saying, it's easy to say it, but very difficult to do. Especially when you see a good setup, you want to capitalize on it. Now, although there is flexibility in trading, especially when, okay, if you see a good setup and you're sure, there are times you just know from inside that this trade will do what you want it to do. You can maximize it. But at the same time, learning disciplines, because most of the time, you will observe that, okay, you are trading very well, following your trading plan. Your trading plan is going on well. And all of a sudden, you just, after making good profits, you just saw a setup and this setup is good. Since I've been making winning streaks, let me just add break my trading plan because I know this is going to do well. And oftentimes it's those times where those disciplines are lost that losses come, massive losses, and everything, the discipline of the past 4 days will just scatter on a Friday when markets are about to close. Now, not managing risks well affects trading psychology. Now, I noticed that anytime I start up a prop firm account, if the first trade I take ends in a good profit, there is more likeliness that I will pass that challenge. This thing just works with psychology. If you see losses on your prop firm account, the first trades you take, there is every likeliness that you might not pass that challenge because it affects psychology. So if you don't manage your risks well, it will affect your psychology and eventually it will make your trading experience not to be good at all. So it's good to manage risks. Now, there is actually platforms where you can do a lot of calculations, how to calculate risks, stop losses, and all of that. Now, I think it was last class I was talking about stop losses. So your stop loss is actually a system for you to manage your risks. Yes, your stop loss is actually a system that has been put in place to manage your risks. So like I said, before you enter in on a trade, you have a plan. If you just go to your Meta 5 and you are tapping buy, then later you're not considering where is the good spot for me to set my stop loss. It's a wrong habit. It's a very bad habit as a trader. So you sit down. That is why it is best you wait for trade to come to your zone. It's just like a trap, more like a trap you are setting. Okay, if market gets to this point, I want to see this and this, then I enter in. So don't just put in trades, then you are now calculating, oh, what's the risk? Or where should I set my stop loss? So I think I should open this link. So you can actually determine the risks that you want to apply per trade. It can be per trade. It can be per trade. It can be per day. Depends. It can be per day. It can be a weekly. A weekly. So, for example, you have a trading account like the $500 account. Some traders can be so strict that, okay, within a week, if I lose maybe 10% of that account, percent of that account, I will stop trading for that week. So it doesn't matter if they lose that 10% on a Monday. It means throughout that week, they won't trade again. They close their laptop. So it could be on a daily basis that maybe 5%. If I go below 5%, my account, I won't trade again for that day until the next day. So some traders can put, okay, 1% per trade. I don't want to lose more than 1% of my account for any trade I enter per trade. So all of these things will be included in your trading plan. Your trading plan. You set your risk management technique you want to use and the percentages you want to use. So the stop loss, many traders ask, is using stop loss good? Yes, using stop loss is good because one of the game or one thing you want to achieve in trading is to stay long in the market, right? You want to stay long in the market, even if you are coming in with $30. You want to tell yourself, okay, it's a discipline actually. I have this $30, but I want to trade it for 1 month. I want to trade it for 1 month. Although this is very difficult because it takes a lot of discipline. But what thing you want to achieve is to stay long in the market. So it doesn't look like a gamble. Okay, it's $30 small. Let me just blow it for 1 day. It will take you another many long days to find another trading capital, unless probably you have money you can be throwing around. But even at that, it can still affect your psychology negatively. So when you fund your trading account, one thing you want to tell yourself is, I want to stay long in the market. So if, let's say, 1 month for $30 might be too long, but let's say like at least 15 days. I want to trade this money for 15 days to manage my risks. Not just that I want to just fund and trade. No, I want this capital to stay for at least 15 days. Let me see what will happen. So if, let's say, 1% of this money will be like $3, right? Is it? Or 10%, 10% will be like $3. So let's say you want to use 10% per trade, right? So if you do this, so actually there is a calculator we can use to do all of this, but let me just show us that. Let's say $3, right? $3 per trade. So if you are risking this per trade, right? You now ask yourself, how many times will I take a bad trade that will swallow up this $30? It will be about 10 times, I guess. So there is no way, I believe, you can take consecutively 10 bad trades unless your village people they pursue you. 10 bad trades consecutively.
Over possible.
My God. But I believe if you really know what you are doing, it's not 10 bad.
Sorry to cut you short, sir.
Yeah.
There are specific periods that would target your strategy. Remember, I said is retail traders make movement happen in the market, then institutional traders make movement happen in the market. But the thing is, these institutional traders, they know every strategy that is out there, whether it's this one you're using, whether it's indicator, whether it's this, they know it, they know where you are placing your trade. For example, every exchange, once you place your trade, you place your limit order, they see where you place your trade, they see your stop loss. Those data, most institutional traders have access to it. So they
Mm.
have chances to liquidate you. So losing 10 trade is over possible. Just know that that period, your strategy is what they are targeting, or is that specific market is targeting high liquidity. That's why I said that's why I've been preaching of being a flexible trader, being an open-minded trader. Not just assume say now one thing you want to do for the rest of your trading career. No. That's where it comes, because that one thing you can be doing can be fetching money, but
Mm.
consistently you can lose. The last class I talked about me joining a conference on Twitter earlier this year when I talked about big traders. We are sharing their testimony. Some within the first quarter of the year, they lost nothing less than 100 to 200K USD every month consecutively. So that shows you that most of those big traders, they've had more than 10 loss within a week and all that. And those are people that have been making it huge in the market since. So having such amount of loss is actually over possible. That's why you need risk management, because if you go put your entire school fees for this thing, you locate your village the next day.
You get these guys where they say, it's ready, please, and you go back to village. Oh my God. Okay, so now the first thing I think I should have said is, please don't trade with money you know when you lose, you can't sleep again. My wife is laughing. Please don't trade with any money you know will affect you psychologically. Like I gave example of someone who traded with money he worked through the summer with. He was supposed to use that money to pay his fees, but he just put it in trade, and it's not even like, that kind of thing that you just put money once and everything just blew. And I think it affected his semester. I'm not too sure. So that kind of thing now, don't put such money into Forex. You cannot conveniently lose without it affecting you. It's also part of risk management. So you start with the amounts you can conveniently lose and it will not affect you. All right, so let me just show us the calculator. Then, okay, first of all, when you pick up your tool here for long or short, so you can always find the tool. For me, it's already pinned here, so you can find long or short here. So let's say you want to long on any trade. This trading view has even made everything simplified, right? So normally when you open this, you can see the stop loss pips. I think I explained this in the last class a little. Now, some traders set fixed number of stop loss, but based on what we have here, if you use percentage, don't worry, I'm going to still open this position size and calculator. You will see that when you use percentage, it relieves you of the stress of using a fixed stop loss number or amount, so that you can maximize on your lot size to take advantage of the trade. Because sometimes some trade will not really require that you use a lot of use a high stop loss. Sometimes it can just be 15 pips or even 10 pips, right? Because of the advantage of the position you enter, or maybe those who enter with sniper entry. So sometimes it can just be 10 pip stop loss you are using. The lower, if you are using percentage, right? If you're using a percentage to calculate your risks, the lower your stop loss, which is your SL, the higher will be your lot size. And the thing is that you still be risking the same percentage. Let's say it's 10%, you still be risking the same percentage. Okay, I think I should just show from here. So there is baby pips calculator. Sorry. Yeah. So you can always calculate your risks before you jump in on any trade. Always calculate your risks before you jump in on any trade. So this big VIPs calculator, you can calculate your risks. You can just use any, maybe Euro account, USD, and let's say you have $1,000, right? And you want to risk 10% of this account. 10% is actually much, this, because that's $100. But let's say you want to raise that. And let's say the trade setup you found, the stop loss is like 30 pips. And let's use GBP USD. So if you calculate this, you realize that the risk amount is 100 USD. That means if the trade setup you are entering moves 30 pips against you, the trade closes and you'll be losing $100. Now, for that to be possible, you have to use this lot size, 0.03, 0.033 at least, or 0.03. Now, see, this risk percentage, as long as it is fixed, sorry, this 10%, as long as it is fixed, you can always modify your stop loss and the amount you are losing will still be the same. That's if you incur any loss. So let's say you find a trade setup that the stop loss is 25 pips. So you calculate, you see, it gives you a higher lot size, and yet the amount you are risking is still the same. So you see a trade that is 10 pips, same amount, but it gives you a higher lot size to use for the trade. So what if it's 50? Same amount, but it gives you a lower lot size to use to trade. So this is why it is advised to use percentage when calculating your risks. So the risk is fixed. If you set it at this 10%, what you'll be losing will be fixed. But you can always modify the stop loss, because there is no need using a big stop loss, maybe 30 pip stop loss, when the trade setup is probably on, okay, let's say for example, you found a very nice sniper entry at this point for this trade, right? So you can always use a very low stop loss, like 20 here, and enter in on this trade. So there's no need increasing the stop loss and reducing your lot size while you can reduce this. Now, not all trades are like this anyways, because some trades might need you to use, because some traders, I'm saying this because some traders just make it fixed. Say whatever the trade is, I must use 20 pips. You have to be flexible. You have to be flexible, because sometimes the trade might retrace, take out that 20 pips, and now still go to that direction of your setup you already planned or analyzed. So be flexible with your stop loss depending on the trade. So most times the last low is always targeted to set stop losses. Right? The last low is always targeted to set stop losses. So yeah, basically you just target the last low the market made, just a little bit below it, right? Just a little bit below. Maybe you want to take a a sell around here, maybe a sell around here, right? So what you do is to set your stop loss just a little bit above the last high that the market made here. Then you extend your stuff. So it's just like 17 pips. Because if market has made this high here, there's every possibility that it might get touch this high before going back. So it's just you being safe, right? So stop losses should be flexible. Don't have a fixed amount that, okay, all my trades must be 25 pips stop loss. You might not really get the best. It's not that it's bad, but you might not really get the best because sometimes there are some trade setups that you just need to increase your lot size. So while risking the same percentage, you can reduce your stop loss and still gain more from the market. Somebody is raising, okay, yeah, Mr. Destiny.
Okay. Let me put what Pastor is saying in layman terms for you to understand is I would not there's no need for me explaining risk management again, but I would be quick with this one. When we are saying risk management, it's not about the profits, this thing or the PIP and all that. Set a specific standard and target for yourself that would help you stay above the market. Then, now this is it. Depending on your finances, set a standard that you are willing to risk per trade, a standard that you are willing to risk a day. That would then help you to be flexible with where you place your stop loss. Let me say, for example, for me, there was a time that I used to trade Forex. Per trade, I am not willing to lose more than $40. So that would help me with my lot size. That will help me determine where I am putting my SL. So let me give you what I am trying to say now. If you are not willing to lose more than, let's say, $20 in a trade, you are not willing to lose more than $20 in a trade, and what you have as your capital is $100, you then put your SL at minus 20 pip. Then let's say the day that you know that areas market may liquidate is below that minus 20 pip, you drag your SL to 30 or minus 40 pip. Now, where your adjustment should be, this is the flexibility. You've pushed your SL from the standard minus 20 pip to minus 40 pip. So where your adjustment will be that will make you still lose the same $20 if it hits that minus 40 pip as it will hit minus 20 pip when you lose your normal $20. What your adjustment is now in is your lot size. That's the flexibility. That's the risk management. So don't come and say they teach me, say only put SF for 20 pip. Now you sabi. Sometimes market will go and take up your SF and you blink your eye like this, you will see your take profit hit. So that is the flexibility. So don't be so strict that this is my standard lot size, my standard stop loss, my standard is my stand. No, nothing standard for this market. Thank you.
Okay, thank you, Mr. Destiny. Please, if you are following, drop one on the chat. So far, if you are following, just drop one on the chat. Or if you have a question, drop number 2. Okay. Is Abel here? Be the chop buy the cake, drink Coke. Okay, I hope you are following anyways. All right. So if we, okay, Mr. Destiny, you want to talk about risk to reward and over trading?
Okay, let me just, breeze through it.
Okay.
Risk to reward is basically the reason why there is such thing as risk to reward is the aim of this market is for you to make money at the end of the day. So risk to reward is a form of a setting or a strategic pattern that every trader has set, and it's personalized, mostly based on your trading strategy, based on your pattern and whatever it is. Risk to reward is something that helps you stay ahead of the market. That's it. So let's say, for example, you're risking 20 pip to gain, let's say 60 pip. That's 1:3. If you're risking 20 pips to gain 60 pips, that's 1:3. Now, what it does is you've made times three of your loss, what you usually risk. So let's say you take 10 trade. Like 10 trade is over trading. If you are trading 10 trade, you deserve to be locked somewhere first in a day. Let's say you are taking 4 trades or 5 trades in a day. And the truth is, most likely, you could probably, out of 5 trades, you could probably lose three. And that means you are short minus $60 for the day. Then if your 2 trade ended up being a winning trade, and let's assume they were all smashing take profits, that means your usual standard is you're risking 1:3. So you've made $60, which is $120, minus or loss for the day, you are still living with $60. That's risk to reward. Risk to reward is something that helps you stay ahead of the market. So if you have a proper and strategic risk to reward, you can have more losing trade than more profitable trade, but still be making money. That is the essence of the term risk to reward. I don't want to go into English language, be waiting when you enter main market and you start to the trade, you will forget the definition of risk and reward, say for dictionary. So what I am trying to tell you is that risk to reward is something that help you play smart in the market. So let's say, for example, you are risking 40 pip. You are risking 40 pip to trade a market of 60 pip. You are endangering yourself, first of all. I won't consider such as gambling, but I would also consider such strategy, though all the time you don't need to wait for your take profit to eat all the time, but have a mindset of whenever you are setting your trade, you are preparing for your trade, you are planning your trade. Have that mindset of risk to reward. Whatever you are putting in you are risking as your SL, your take profit target should be able to double it or triple it. If it is not, be careful of that trade. If the market is not so clear that your take profit is not doubling your SL, know that you are scalping. And as a scalper, your SL should not be large. So that should automatically rewire your mentality and your approach toward that specific trade. Whenever let me put this thing again, like a form of an instruction, please, to help us. I'm not saying you must follow it, but if you want to help me help you, whenever you are planning a trade and your risk, your reward is not up to times 2 or times 3 of what you are risking, which is your SL, please rewire your mindset from a proper trade to a scalping. Automatically, what you are doing is scalping. If your reward is not up to times 2 of your risk, automatically what that is called is a scalp, and a scalp should have a tight SL, because meaning you are taking an abnormal risk. You just want to make a quick profit and leave. So there's no need of you using large SL. You get the point now. This is the mindset you must carry, because some people come and they can place a SL at 40 pip, take profit at 40 pip. You are not trading with risk management. And yes, mind you, people will come with the question, but all these big traders, all these people that are driving Lamborghini, that's what they display on their charts. That's the pattern they use. First answer to your question, they have Lamborghini. They are gamblers. They can decide to gamble. They can decide to scalp and still have an edge in the market, still be profitable. So you that is building, what you are focusing on is called compounding. You should not have the mindset they have. That's why you need a structured risk management pattern. And risk management pattern is mostly personalized depending on your emotions. So this is an assignment for you to go and find. You can learn someone else's risk management pattern as a starter pack. You can learn from Pastor. You can say, Destin, please, can you drop your risk management pattern? I will find time. I will drop it. This. You can learn from Mr. Emmanuel and all that. Then on your own time, as you start diving into the markets, you sit and study and find what you can deal with, what your emotions can deal with for you. That's as simple as it is. You get now. Then what overtrading is in risk management is, overtrading can be as a result of optimism, greed, gambling, and most likely, I would say, emotional attachment. Yes. Now, let me start from the back and explain. If you're emotionally attached to a specific pair, you will overtrade. Because most times when you're emotionally attached to a pair, you no longer analyze the pair. You feel like you know the pair. You feel like una two na how did they call it? Two shall become one, and all those things. And that gives you a certain level of confidence. And trust me, the market will break your ego. It will overbreak it. And that will lead to overtrading, because each time the market breaks your ego, you want to have an edge. You want to be a winner. You dive in again. You dive in again. You dive in. Literally, the term overtrading is trading too much. That's why I said if you're having 10 trades per day, you are definitely overtrading. 10 trades per day, you are I'm not saying taking up to 10 position per a pair. If your strategy permits you, if your strategy and your risk management permits you to take up to 10 position in a pair, especially for those trading Forex, fine, that's understandable. But if you are trading 10 trades, 10 different patterns, even if it's one market, you have bought, you have sell, you have do this, you have do that, you have followed this one, follow that market, the long, you long, the short, you short. If you are trading like that, 10 trades per day, something is wrong. Something is wrong. And it can either, it's not your trading strategy. What is wrong is inside you as a trader, is your trading psychology. That's it. If you're emotionally attached to a pair, you will overtrade. You feel like you know the pair. You jump in and drop out anytime you want to gamble it. Then if you're a gambler, you will overtrade also. Because your high, you just want to be ahead of the market. And when you lose, you don't want to accept defeat. That result to revenge trading. If the moment you find yourself revenge trading more than 2 times, consider that as overtrading already. Let's assume you traded once and you lost. You jump into the market again without any form of clarity. You revenge trading. The second time you lost. You revenge trade again. You revenge trade the first time, you lost. You revenge trade the second time, you lost. If you are jumping inside that market again, And that you are not calling it quit for that. If you are jumping inside that market again to revenge trade for the third time, you've already started over trading. Mind you, that's like 4 times you've traded that day. That is considered an over trading compared to someone who have a clarity in the market and took 5 trade a day. That person did not over trade. You that took 3 revenge trade and your trade that day is 4, you've over traded. Overtrading is the term overtrading is you like I will not say, I don't know how to put this thing. It's mostly depending on the amount of trade you've traded, the quantity. But sometimes also the quality is also there. Meaning if you've traded like 3 trade and they are all on loss, the 3 trade are all on loss, you are prone to reverse trading. You might probably need to take a break, even if it's for 4 hours, 5 hours, and come back in the evening and take one more trade. That's better. But if you trade 3 trade back to back, they're on loss, and you are pressing another button again, that's also a form of over trading. And that leads me to the last one, optimism. Optimism. You know this thing of, mind you, yeah, being realistic in the market does not have anything to do with your faith. Let me differentiate this. Does not really have anything to do with your faith. When, just like I said when I was talking about market structure, when you see market is choppy on 1 hour, 15 minutes, or 4 hours, and it's that same specific market upon all the many pairs we did this world, in that specific market, you feel like as the candle is green, is going up. That's optimism. You've left reality. You've left the analysis. You've left full technical analysis. You forget fundamental analysis. You threw everything away. You just believe. Based on belief, based on faith. I am sorry. That's optimism. And you are already over trading, especially when you are using that mindset to enter trade or 2 or more trade. It's already considered over trading. You don't trade based on what you believe or optimism that, oh, market is going to pump. Is that optimistic mindset that pushes a lot of traders to loss, because they believe you see trade is going against you. They increase essay, they carry your essay, go down, they drag and they go down. Trade is going against you. They knock your essay, go down. You are enlarging your essay. And if they now ask you, you say, you believe the market will pump back, it will reverse up. No, please. I beg you. Don't, anytime you ever as a trader, anytime you find yourself in such situation, please close the market. Take the next 24 hours to restudy everything you've ever learned in trading. You see this specific one I'm talking about, this optimistic mindset that you are trading based on belief, based on you just have faith that the market will pump or it will sell. You throw away technical analysis. You left reality. The market is displaying reality for you. It is displaying the obvious thing for you, but you are working based on belief. Please, the moment you find out that that is the only thing you are carrying as a signal, please close your laptop, lock your phone, take a deep breath, spend the next 24 hours to see. The reason I am saying this is I have this thing that's always kept me safe. Whenever I notice I am over trading consistently for 2 to 3 days, whether it's mostly on loss, or most overtrading will result to loss. But mind you, there are specific times that overtrading will result to profit. That would then make you grasp that mindset of overtrading. And the period that the loss want to come, let me tell you, let's say overtrading put you on profit today. Tomorrow you try it, put you on profit. Mind you, what Wednesday, Thursday, Friday will do to you in the market, you will not like it. I'm being honest with you. Every trader has experienced this thing. If we tell pastor to unmute now, say probably has experienced that thing. If you carry mic and go and do interview and do a survey, 100 people 100 traders you are going to interview, 90% of them, they've experienced this thing. If you overtrade and it's profitable, day one, day two, the next 3 days, what will happen to you? You will even lose those profits, and you will then lose from your capital, or probably even lose the entire capital. So the moment you find yourself over trading, out of everything that we've talked about in risk management here, this specific one, leave the rest. The moment you find yourself over trading, please go and revisit everything you learned, even if it's from the beginning, from market structure, go and do it. The reason why is that you lost 2 things from your strategy or your knowledge. And trust me, when you lose certain things from what you've learned in trading, it does reflect on your trading. It will reflect, because you are now trading based on belief, based on, I don't know the markets, I know waiting gold they do, I know waiting gold they behave. If gold reach this level now, waiting they do. No. So I am using this opportunity to tell you that overtrading is one of the most dangerous thing that will ever happen to your risk management. Overtrading is what will make some people lose 10K in a day. Mind you, that loss started from 1K, 2K. They for rest that day, but they kept trading because it's either they are revenge trading, or they are trading, they are gambling, or lastly, they are trading based on optimism, based on belief. And whenever any of this form is happening, it's already considered over trading. Person will get 10K as capital. You take your first trade, 1K minus, win. You take your second trade, 2K again, you see them, you enter the third one, another 1K come out. You continue. That is over trading already. And I bet you there is this thing about trading psychology that whenever you are over trading, you are more confident when you are over trading. You are more confident. Someone that is gambling this market, that is over trading, can argue this market with you. If you tell the person that this market is consolidating, the person will tell you that this thing no, they consolidate. And they can bring different things to prove it to you. But please, have this thing at the back of your mind. I am saying it today because it will help you. The moment you find yourself over trading, stay away from the market, revisit everything you've learned. Even if you don't have the time and patience to revisit everything you've learned, stay away from the market, even if it's for a day. And trust me, one of the best risk management strategy you can also do to yourself is learn to take breaks from the market. You cannot trade from now till the last day you breathe on this earth. No. Learn to take breaks. Learn to. And this is where flexibility comes in. If you're a flexible trader, the period that you don't understand what the FX market is displaying for you, you can take break. And that period, if it's just Bitcoin, you are just trading small, at least, even if it's not the weekly profits you are gaining for FX, let's assume, say, okay, you gain, let's say every week you make up to at least $200 from the FX market. Then the period that you notice that something is happening to your risk management, you are losing more than you are making, you take break. And let's just assume you only trade Bitcoin and Ethereum for the next 1 week while you are just observing and studying the chart, the FX chart, and all those things. Let's assume that 1 week you took break from FX market, you make $50 from the crypto market. Trust me, it's far way better than you gambling that FX market, because what will happen to you, you will not like it. You will not really like it. And whenever you feel like you are missing trades back to back also, please take break from the market. It's another form of risk management, because you will not know when you will revenge trade. You will not know when you will jump into the market blindly, because you will think you are trying to conquer fear. Wallahi, the fear has already conquered you a long time ago. If you miss trade back to back consistently for a specific period or in a day, please leave the markets that day. If you miss trade consistently for 1, 2 to 3 days, please leave the rest of that week. I am telling you the truth, because when you decide that I will conquer this fear, is it not to click the buy button? As you click the buy button, market collect your money, go. What will happen to you? You will not start regretting. Share the trade that was supposed to give me profit, I did not take it. The one that I took now lead me to loss. What happened? If you still have more capital, you will go and still click that button because you want to defeat more fear. The more fear will then defeat you. See, in as much as I am saying this thing in a very, very funny way, I have studied the act of every form of trading psychology. I'm telling you, these things I am telling you, you will not see it and buy in the market. You will experience it, but they are so deep. Can be funny. I am including pigeon, whatever, but this is the reality. This is what you will face in the market. I am telling you the truth. Let me give you another example of risk management. Last week, we analyzed gold, we analyzed GBP USD, we analyzed Bitcoin and Ethereum. They all sold. They all moved as expected. All the session we have, they all did that. And I did not take advantage much of the market. I took 2 crypto trade. They were okay. Did you see me this week approaching the market with one kind of high morale or motivation? They not be by all those ones. So no, I did not. As I'm speaking to you right now, if I share my screen, I am currently on 2 trades. But I did not approach the market with that vitality of, last week I missed a lot of opportunities. I analyzed GBP, I analyzed this, it go on profit. Oh yeah, let me knock lot size. No, please, no. Because what would then happen to you? You would not like it. So I am saying this because one form of risk management that you would not really pay attention to is the risk management that happens to be so related to trading psychology. That's the greatest form of risk management. You don't know when the market is playing you. You cannot cut off yourself from the market. No. When I understood trading was when I learned, I know when to take breaks. I know when to take 2 to 3 days off. Some specific break I take is to relearn. Some specific break is to study the chart. I can open the market, analyze every day. I will not take trade, no matter how the market is moving my way. Some specific trade I take is from the entire, anything that has to do with trading. I will not open chart for 3 days. If I make I receive notification say Bitcoin hits 2 million, I would not open. I promise you. As long as I'm still on that break, I would not. So this pattern, the reason I'm not explaining risk management is Pastor has touched what risk management is. But the risk management I'm explaining to you has to do with trading psychology. I've finished explaining over trading risk to reward, but what I am dealing on right now has to do with your trading psychology. And I'm telling you, again, I will say, 1 is know when to take break. Secondly, is know when you are being optimistic, know when you are gambling, know when you are revenge trading, know when you are over trading in general. Then, now, the greatest mentality I would teach you concerning risk management, this is the last one. And if along the line more, I remember more and all those things, I will drop it, I will share it in the group, we will talk about it. but this is the last one I will talk about. Is I want to ask this thing as a question, and I would love somebody unmute and answer. Imagine, you dey go somewhere. Let's say you bust enter UK. They say, okay, take train, go so city now where you go reside and all those things. Now, your transport for that train, they gave you a specific direction. They gave you a specific direction, and that is the last money in your hand. Now, the thing is, you only know one direction. For the sake of that money being in your hand, that is the only direction you want to face, because if you are stranded, you don't have another money to go somewhere. What will you do? Even if the train you are to take to that city is 4 hours, you would want to wait for that 4 hours. Am I right or wrong? Please, I would need somebody to answer.
Yes.
Good. And if someone then comes, Oga, if he take this bus, enter the city, from this city, corner, enter here, corner, enter here. Imagine you then, out of lack of patience, you follow that person word, or you yourself, you just on your own sit down. Wisdom. Make I just take shortcuts, reach here first, then reach here. Now, what would that lead you? You will be stranded. Probably you don't know where you are at that moment. And thirdly, you've lost your transport fare. You've wasted the money. So you are now stranded in an unknown location and you don't have money to redirect your route and all those things. Is that not what will happen in most likely that case?
Yes, sir.
Okay, now, this is what I want you to understand. There's this thing I and my friends always say. Your capital, now your transport fare. If you lost, you no go see road, go house. Please have this thing at the back of your mind. Your capital is your transport fare. For years, as funny as this thing is in Pidgin, it has always been in my head. I rather close my laptop than to lose all my capital. You see all those things that they will say, motivation, 2 trades or 0 point something loss size, no, they buy Lamborghini. I'm sorry, if you lose all your money, you will not see Elo. You know, go see that L where we start from the beginning of Lamborghini. And if you continue high risk trading continuously, the day you will sit yourself, you then notice that within a month, you've lost money that you are supposed to buy food stuff in your house. You've lost money that you are supposed to use and eat. Stomach food no day. Trading account money no day. You don't put yourself for double risk. So please, your trading capital is your transport fare. Protect it. Have this mindset that if I mismanage this thing and it goes away, I will be stranded. I know people have somewhere to refund. I will refund. I have never had that mentality. It helps me protect. Sometimes if trades are uncomfortable for me, I don't jump in. I rather protect that transport fare. I rather stay in a whole month. My total, if I minus loss and profit, the entire month I went home with $50 to $100 than over trade, over leverage, over risk, and the entire month my $500 then go away for that month. That's my mindset. It better make my capital remain than say I gamble the market. You get the point now. That's the greatest risk management mentality you can carry. Your trading capital is your transport fare. If it goes away, you will be stranded. If you have that mindset and you think there is a place I will always fund from, there is a place I will always fuel from, trust me, this is business. That day you will not see that place, because even that place you think is a source that you can always fund your trading account from. That place is called capital also. Is your transport fare. So meaning you are squandering everything, and if it finishes, where will you then collect from to fund? So whenever you feel like, oh, I still have $500 in one of my wallets, if this $200 disappear, if it eats, I will refund my account and knock the trade. Ask yourself the question: that $500, if it finish, where you go see another next $500 from? That is the main question. Whenever that trading psychology or one form of mentality is pinching you that there is money somewhere to use and refund your account. Let's say you are even trading prop firm. Whenever you are mismanaging your prop firm account, you are gambling it, and you have this mentality of, I still have $100 to buy 2 more accounts. Ask yourself, if that $100 finish, where I go get money from? The moment you start respecting your capital, you have high level of respect for your capital. You have high level of protection for your capital. Your losses will then minimize. So even if your profits rate is not increasing, you are understanding the market. You are consuming knowledge for the right time. But now, I will tell you what people don't understand. If you don't protect your capital, you don't respect your capital, your losses will increase. You will be losing knowledge. You will be gaining negative experience. You will be losing experience also. You will be losing knowledge. You will be losing pattern strategies, and at some point you will become a total. I will use the statement riffraff in the market, because you don't know what you are doing. You are lost totally. So have this mindset that even if you are not too profitable, but your losses are very, very minimal, you are in between, it does not make you a bad trader. Whenever you feel negative that you are not highly profitable, please take this from me. I myself, trading for years, they've been a specific year was that I was not moving forward, I was not moving backward. I sat down, I reflected on the whole year. I checked 3 exchange, Bitcoin exchange. I was using crypto exchange. I was using to trade crypto futures. I checked 3 exchange. My brother, I checked the entire year record. I'm minus and profit. One of them was showing minus $50 after I traded with more than $1,000. After I traded with another one that was more than 2K, I'll be something, it was showing positive 100. So in the entire year on that specific account, loss minus profits for $100 that was remaining, I had this across 3 different accounts. It was like I did not progress that year. But guess what? That was the year I learned a lot about risk management. That was the year I learned a lot about trading psychology. That was the year I learned how to stop the market. Whenever the market is trying to manipulate my brain, I know when to stop. So take it from me. Whenever it feels like you are not progressing, you are not highly profitable, ask yourself, are you losing money that much? No. Your loss is minimal. Then you should be happy. You should continue and stay focused till it get to a point where you've then learned something strategic that can then help you to be profitable. Fine. But please do not because and say, oh, I have not been profitable this whole month. Then you just wake up, see how many lot size, you know, look risk, you know, look reward, you go knock am for gold. I am sorry. What would happen to you? You would not really like it. So that's all I have to say. The greatest form of risk management is respect your capital. That's it. Respect it. I think that's all I have to say for today.
Okay. Thank you so much, Mr. Destiny.
And sorry, sir, let me quickly add. There was one thing I posted on the group. There was one thing I posted on the group the other day. Let me quickly just touch it. When I talked about people not investing in themselves first before they fund account to trade or invest in business, I would also say it as to explain to people who are starting this journey newly. I am not saying be scared to fund your wallet to trade and all that, but please don't do it at the expense of money you want to use. Don't do it at the expense. Let me even put it to you. I know there is a statement called sacrifice, but please don't consider such a sacrifice. Don't fund your account. Don't generate capital from a money that you are supposed to use to buy food stuff, for example, money you are supposed to use to pay rent, pay school fees, go on a journey, do this or that, something that has a certain level of importance in your life. Please don't do it. No day say person give you $500, say help me hold them, I beg, I go need them next month. You then fund accounts from that money. In as much as everybody might seem like I'm disciplined, trust me, I keep saying this thing that when you are deep into trading, you will know that there is more to the statement discipline than you ever knew before. So I am saying this, please, is another form of risk management that you will not understand till it happened to you. Don't fund. See, let a trading capital be like money that you are willing to lose, that if you lose, it will not affect any aspect of your life. I understand the money is the finances, but whenever they are saying lose what like trade with what you are willing to lose, they are not saying the money will not pay you. They are saying let it not be money that will cost something in your life. Let it not be money that will drag you into debt. Let it not be money that will make you not be able to pay rent. Let it not be money that will make you not be able to do this or that. Let it not be money that will make you not be able to eat for 1 week. Say because you know get food stuff for us, you use your last $100 go use trade. Please, I am saying this because the moment you dive into this negative pattern, you lose risk management first of all, because you no longer want to follow risk management rule. Your trading psychology is messed up, and those things will now reflect on your technical analysis, because why? You are not able to follow any form of strategic pattern again. All you do in the market is just come and mess up around. I am saying it. The moment you make such mistake, you've lost everything from risk management to trading psychology, your technical analysis. You've even lost it. You will forget what support is. You feel the set markets don't reach support. Where you as a normal trader, you assume say, okay, when markets reach support, make I wait. Probably there is a form of retracement that will happen. You go say no. Now that point you want to sell, because all you are just after is to try to make $10 and recover losses, or try to make $50 and recover losses. At that point, you no longer understand anything in the market. And I think that's all for tonight.
All right. Thank you so much. Do we have any questions so far? Any questions so far? Okay, everything is well understood, right?
Yes, sir.
Okay, that's great then. So please, this video, I will recommend we watch it over and over again, because this aspect of trading is very, very important. Very, very important. Most traders will chase after strategy, but they don't have good risk management. And because they don't have good risk management, it will look as though that strategy, even no matter how perfect it is, without a good risk management, it will just it will be as though it's a flop. So please practice this. Most times, I believe, when risk management is being taught, it doesn't really enter it doesn't enter the hearts of traders until they practice it and see real losses in their account. But please, you can learn. You don't have to learn by experience. Yes, you can learn practically by just taking this and practice it. It's better that way. See, recently I did something. I bought some prop firm accounts. See, the mistake I made was, these prop firms, they'll be doing you bonus. It's like when they start doing this, their bonus, it just cuts your mind from thinking straight. I bought like 3 accounts, right? Which is a big mistake. Now, you can be trading $50 or $30 account, and sometimes because you know that before you got this amount, it was so difficult, so you trade it carefully. I bought 3 accounts. I just realized that I began to trade very carelessly because I just thought that this one blow, another account, they sit down, they wait. Just buttressing on what Mr. Destiny said, right? Capital, managing capital. And one by each, the account just they blow like that. One by each, the account is just blowing like that because fail to manage capital. Just feel that, okay, if this one blow, I'll always still get. No, it's beyond just that. I now discover that it's beyond you just always having the ability to fund your account. Yes, you can have a good source to fund your account always, but that psychology you are painting is what will make you either a good trader or a bad trader. So please, let's practice this. Watch this video again to be of great help. Then I think we can do a part 2 of this on Wednesday. All right, so if there's no more questions, let's end the meeting here. All right, have a good night, everyone. Take care. Thank you for your time.
Thank you, sir.
Yeah.